Hello everyone, welcome back to the channel. This presentation is brought to you by Synergy Business Advisors, Noida, your trusted business mitra, providing complete advisory solutions. Our today's topic is about preferential transactions under IBC. Can a preferential transaction under the Insolvency and Bankruptcy Code be reversed even if the person who received the money has already passed away? And more importantly, can suspended director escape liability by simply saying we don't have the records anymore? The NCLT New Delhi has given a clear, strong and very practical answers to these questions in case of Rajesh Toshniwal and another versus Kamal Nayan Jain and others 2026. Background of the case: the matter arose during the corporate insolvency resolution process of the corporate debtor. During CRP, the resolution professional conducted a transaction audit as required under the IBC. Based on this audit, the RP identified certain transactions as preferential transactions under section 43 of the IBC. These transactions involved transfer of money by the corporate debtor to related parties before the commencement of insolvency. Now, two key complications arose. One, of the beneficiaries of these transactions had already died, and second one, the suspended directors claimed that the transaction auditor did not have sufficient documents to conclusively establish that these were preferential transactions. On these grounds, the suspended directors challenged the findings. Before we go further, let us briefly understand Section 43 of the Insolvency and Bankruptcy Code. Section 43 deals with preferential transactions, a transaction which is considered preferential when the corporate debtor transfers property or money to a creditor, surety or related party before insolvency begins, and such transfer puts that person in a better position than other creditors during CRP or liquidation. The idea behind this provision is very simple: all creditors must be treated equally. If a company just before insolvency favors certain persons, especially related parties, it defeats entire purpose of IBC. That is why preferential transactions are strictly scrutinized and can be reversed. Key issues before the NCLAT in this regard were: in this case, the NCLAT examined three very crucial legal questions. Number one, if the beneficiary of a preferential transaction has died, can recovery still be ordered? Number two, can the legal representatives or heirs of the deceased beneficiary be held liable? Number three, can suspended directors avoid liability by not providing books and records to the IRP or RP? Findings of the NCLAT. Now let us come to the important findings of the NCLAT. Death of the beneficiary does not extinguish liability. The NCLAT held very clearly that the death does not wipe out liability under the IBC. If a person has received benefit from a preferential transaction, then that benefit does not become legal merely because of the person has died. The tribunal has held that legal representatives of the deceased beneficiary can be directed to return the amount received under a preferential transaction. Unlawful benefit cannot be retained by heirs. This is a very important principle. IBC focuses on recovery of value, not on personal punishment. Suspended directors cannot take advantage of their own default. On the issue of suspended directors, the NCLAT made a strong observation. The directors had failed to provide books of accounts, financial statements, and records to the IRP and RP. Later, they argued that the transaction audited did not have sufficient material to conclude that the transactions were preferential. The tribunal rejected this argument outright. It held that the directors who withhold records cannot later blame the auditor. No one can be allowed to take advantage of their own wrongdoings. Burden of proof shifts to directors. Third point. The NCLAT further clarified that once the resolution professional establishes that money was transferred to related parties during the relevant look-back period, the onus shifts to the directors to prove that such transactions were not preferential. A bare denial or oral explanation without documentary evidence is not sufficient. Final takeaways. This judgment sends a very strong and clear message that preferential transaction liability survives even after death, cannot retain unlawful benefits. Suspended directors must fully cooperate with the RP. Once related party transfers are shown, directors must justify them with evidence. This case significantly strengthens the hands of resolution professionals and reinforces accountability under the IBC. This is C&IP Praveen Agrawal thanking you for watching. I hope this presentation will be helpful for you. Please subscribe to the channel for more such informative videos. Thank you.